Welcome back to the Central Arizona VITA Network 2021 VITA Tax Law Training. In this segment, we're going to conclude our discussion on adjustments, discuss deductions, and introduce credits. So let's get going.
All right, ladies and gentlemen, we've talked a lot about child tax credit and the child and dependent care credit. You don't have to remember all of these rules because TaxSlayer auto-calculates this stuff as long as you put the material in the dependent information correctly. I should say for the child tax credit. For the child care and dependent care credit, yes, you have to do some inputs in that screen where you put in the provider's information and then how much was paid for each child. And as long as they balance out, that the amount that the provider received is equal to the amount that was determined for each of the children, then TaxSlayer is happy. And when you get to that screen, if you look back on those screens, you'll notice that it keeps a tab at the top. It'll tell you you put in $1,100 for the provider. You need to put in $1,100 for each of the kids total, and then it'll say zero difference. And as long as there's zero difference, then you've accounted for everything in that credit. For the child tax credit, you don't have to know whether it's $3,000 or $3,600 or what age they are. If you put the information into the dependency page at the very beginning of the TaxSlayer software, the TaxSlayer software will do the calculation for this credit. The only time that you really need to understand the rules is when a client says, well, how come I got this much? Then the quality reviewer needs to be able to say to the client, well, here's an explanation for why. That's something that you will learn as the more returns you do. So don't sweat the stuff at this point. So we've covered the child tax credit, the child and dependent care credit, and we're going to have a few more that we want to cover today. So let's move on. The earned income tax credit is what I call the bread and butter of the VITA program. This is where most of our clients receive their most refund. And the refund goes from anywhere from $1,502 with no children up to $6,700. It's refundable. The entire amount can wind up going as a check to them. And it gets people out of poverty. I read someplace a few years ago that the federal government has 3 programs that deal with reducing poverty in America. The number 1 program is welfare. The number 2 program is food stamps. And the number 3 program is the earned income tax credit. This is a chart that kind of shows you, it's not really accurate, but it's a chart that shows you how the earned income credit can climb and then plateau and then gradually diminish as the income from the adjusted gross income increases. So that, and it also shows both single and head of household as well as married filing jointly amounts. The problem is that if you claim a child who doesn't qualify, that's one of the most common mistakes. So we want to make sure we apply the rules correctly. And even though I say make sure we apply the rules correctly, I know that if I put the information about the child as a dependent of the taxpayer into the software back on the dependency screen at the very beginning, the software calculates it automatically. There is a menu that says Earned Income Credit Checklist. And that checklist menu asks you a series of questions. It's kind of a reminder of the things that we should be looking for. Back when the TaxSlayer software first got its contract with the IRS, the checklist was required. We had to fill it out in order to get the earned income tax credit calculated. Now it's there as a checklist just to remind us that there are ways that this could be used for fraud, and we need to keep our eyes open. But it's optional. It's something you can click on and go to the screen and look through the menu and answer the questions. But it kind of triggers in my mind, okay, these are things, yeah, I saw this with the client, I understand that, and I put the stuff in the software, so I'm confident that it is working correctly. Well, we've changed some of the rules this year. This year, you have to be at least age 19. Last year, you had to be age 25. So we've expanded the clientele that are eligible for EITC. But you still cannot be a dependent of another person, and you still have to have lived in the United States for more than half of your life. I didn't put on the screen, but it used to be from 25 to 65. That was your EITC age limit. Well, now it's 19 to whenever. However, this is still the same. I-10 holders are not eligible for this credit. Now, this is a new one for this year, and it occurred last year as well. And this presents us with a problem. The earned income credit is based on how much income you had. Well, you might have had, because of COVID-19, you might have had more income that you could use in 2019. Or maybe your 2021 income is better. So you've got to be able to go back. The problem is we only ask our clients to bring in last year's 2020 return. That could present some problems for us this year. But the software gives you the option. There is a checkbox on that first screen where we enter their name and address. And then it asks some checkboxes like, were they blind? Were they over 18, under 24, and a student? One of them is the client would like to use their 2019 earned income for calculations. And when you click on that, then there's another menu that pops up that shows what was the amount that they claimed in 2019. So we're going to have to deal with that. And I'm not sure at this point how that's going to be resolved. If I did, I would tell it to you. All right. And tab I, it's all about the earned income credit. So tab I is where you need to go to check off all the answers that are required. So here we have Ross, an eligible foster child, Vince. Vince is 14 years old, began living with Ross in August. Ross's earned income and his adjusted gross income are $14,000. Can Ross claim the earned income credit? You have to have lived with the taxpayer for more than half a year. One of the questions that was brought up is if they used a VITA site for 2019, are we able to retrieve that data? We have been able to do something called global carry forward of data since, I believe, 2017. And if a taxpayer client gives us permission to use global carry forward, then the software, TaxSlayer, saves most of their information in the cloud on a secure server. And when I sit down with them this year, when I type in the social security number and their name, a message pops up from TaxSlayer that says, there is stored data ready to be brought forward. Would you like to do so? And if I click yes, it then brings it forward. And it has things like their name and their address, their social security number, their telephone number. And that saves me typing time. And that information is brought forward. What it doesn't bring forward, it will bring forward a W-2, where their last year's W-2. And it'll have the employer's tax identification number and name and address, but it won't have any dollar amounts in the W-2. It's figuring you're going to put that new information in. It's handy in one way in that it will give us, it will save us time of typing, but on the other hand, we have to double check because if somebody moved, we'll have to go back in and change the addresses. So we have to be careful about how we do that global carry forward practice. So here's another example. Julie's 29. Go ahead.
But just to carry on, because she's asking if it would have the 2019 data, and they have access to it if they prepared their return. TaxSlayer has access to it, but we don't really know if they're going to bring that forward or not. They haven't told us that.
Good. In this case, Julie is 29, is unmarried, and beginning in March, Julie and her son Mel, who lives with Julie's father Rex, age 61. Julie's source of income was wages of 19,000. Rex's sole income was wages of 12. Can Julie or Rex claim the earned income on the basis of Mel? Only Julie, or Julie and Rex both, or neither Julie and Rex both, or all of the above? Well, it can't be, none of the above. It could be none of the above because those could all cancel out. Well, Mel is a qualifying child of both Julie and Rex. But because of the rules for a qualifying child of more than one person, only Julie can claim Mel for the earned income because Rex's income is not higher than the highest AGI of any parent. You know what? I don't get too involved with the tiebreaker rules. I haven't seen them. Any client that I've dealt with for earned income tax credits, even if they're separated, even if it's a daughter living with her father and a grandson is in the house, they're fairly clear and well-defined when they come into us. And I've never had to ask about tie-breaking rules, but if I had to, my site coordinator is the person I would go see. The credit for the elderly or disabled. You might see this. It's for people who are 65 and older at the end of 2021 who were permanently and totally disabled on the day you retired. You've received taxable disability payments, but you have not yet reached the mandatory retirement for your particular industry. The income level is so low, I doubt you will see anybody for this, but there is a credit. Unmarried filing separately, of course, you can't take the credit. And totally and permanently disabled, you have to meet both of the following conditions. It has to be, they cannot engage in any substantial gainful activity, and the doctor must determine that the condition has lasted or can be expected to last at least for a year. Earlier, we had a person who had asked me about what about a person who has been diagnosed with ALS. If a doctor, and I know of this because of a relative who's gone through this terrible disease, once you're diagnosed with ALS, you become permanently disabled. That's just by law. And at that point, all of your disability payments become non-taxable. But at this point, that's really one of the minor things in life, because what you're looking at is a degenerative disease and death. So this credit ranges from $3,700 to $7,500. We don't calculate it. I could not possibly do this job if it was 30 years ago, because some of the guys that I've talked to, they said they had to prepare, they were VITA volunteers, and they had to prepare the tax returns with carbon paper in between the two forms, and so they can make a copy for the client and a copy to mail in. And they had to use an adding machine that was one of those 10-key adders. I couldn't do that. They had to look up how much tax in each of the tax tables and figure out how much credit there was for the dollar amount for the AGI. Nowadays, the software does it for us. Thank God. They have credit for other dependents. So you might have a dependent child who has an ITIN number. They don't have a Social Security number. You could claim that child as a credit for other dependents. Now, are you going to get a credit of $3,000 like you would for a child tax credit? No. You're going to get a credit for other dependents, which is only $500. But That's better than zero. The retirement savings contributions credit. The government's trying to get you to save for your retirement. And so they put in a little credit. It's non-refundable. It could lower your tax to zero if you had tax liability. But you have to have set aside money from your wages into a retirement account. And so on the box in your W-2, in box 12 and 14, there are codes and there will be dollars amount. And you can look at those codes on the back of the W-2 or on the in the 4012. And those codes will determine what the retirement account was. I don't have to figure anything except putting those codes in. The software takes that calculation in. Now, it kind of depends on the amount of your AGI and how much you put in, but you could get 50% of your retirement contributions on the credit up to the limit, or 20% or 10%. And it's kind of strange how that determines that. But it is a really beneficial credit for taxpayers with low incomes. The maximum credit amount is going to work out to be $20,000. Let me get rid of this. I'm missing a part of my thing. Is $1,000 or $2,000 if you're married and filing jointly. 50% of $2,000 in contributions or $4,000 in contributions. And why did I freeze up here? Okay.
Can I interrupt for just a second? Because Mary Ellen is asking a question, and I'm going to ask her to clarify it, because she says, is this retirement credit on top of the IRA not being taxed? And I'm not sure where that comes in, because, but let me say this, because I think this might clarify it for her. Okay, most of our clients are not making contributions to an IRA. I personally would like to see that, to promote this credit and see that go up. But where we see this is where they work and they participate in a 401k plan, because sometimes the employer matches it. And when that comes through on the W-2, and if their income is low enough, the tax software is going to calculate that credit. But that credit has nothing to do with when you say an IRA not being taxed.
What I meant was as I remember, any IRA or 401k contributions you make are, well, 401k contributions you make are not taxable. I mean, they're done. I mean, they're not taxable until you make the withdrawal.
Correct.
So is this contributions credit something else?
Yes.
On top of that? Yeah. Okay.
Yes, it is something else on top of it. It's the government's way of trying to help encourage people to save more, because they're saying if you're low enough income, and this really is a pretty low income one. I can't remember the exact, or do you have it right up here? Yeah. You're saying you got to make less than 33,000 if you're filing status as single. So, think of $15 an hour, that's 30,000 a year. It's not much money. But if they're contributing to a 401k, then the government says, here, we're going to boost this up even a little bit more for you. And if they were to, if they were to make an IRA contribution, say that they were to make a $2,000 IRA contribution into their own IRA, then they would get an additional credit on the tax return, such that, here, let me give you an example, because in a way, and I'm trying this out, because in a way we would like to encourage these folks to start saving. So I say, hey, look, Joe, you're going to get a $1,000 refund. I'm going to tell you what. Why don't we say here, you're going to make a $2,000 IRA contribution. That way you take your, or just $1,000 contribution. That way you take your refund and save it. And then when we put this in the tax software, it's going to increase your refund by, I don't know the exact amount, but I'm thinking $200. So then you have to make this contribution by April 15th. I probably confused everybody with that. I'm sorry if I did, but
it's quite similar. It's quite similar to what we do sometimes with people who make credit or make like a contribution to an Arizona credit between January and April, because they're still going to make the payment to they can either make the tax payment to the Treasury, or they can send that tax payment to their choice of charitable organizations. So it's the same kind of format. We're telling the guy that you can make that contribution to your IRA, and the government will give you a credit as a percent of that. And I want to say it's either 10, 20, or 50%, depending on your adjusted gross income level. So the minimal amount, if he made $1,000 contribution to his IRA, the credit amount that should show up in the software would be $100 credit. And that would be subtracted from whatever tax he owed.
So it's just an additional incentivization to
Bingo.
save. Besides, putting it away in a 401k or putting it away in an IRA, and then not having income tax on that, then with whatever money you are being taxed on, it will be reduced because of this contributions credit.
Correct.
Contributions credit.
Yeah.
Okay.
Okay,
Thanks.
next credit is the non-business energy property tax credit. I don't think we're going to have very many of our clients use this. I've only run across 3 or 4 in the last 8 years, partly because it kind of comes and goes. It's one of those that was there, then it wasn't there, now it's back, and it's going away again. They've already said that this year or next year will be the end of it. So the non-business energy tax credit, it could be 10% of the cost up to $500 total for the lifetime. So, if you get it 1 year, you're done. But there are some specific amounts between $500 and $300. It expires at the end of December 31st, unless they renew it. And there was some discussion just yesterday about that. But it has to be on your existing home and your principal residence, but new construction and rentals do not apply. So things that they would give you credits for: insulation, 10% of the cost up to $500. Roofs like metal or asphalt, 10% of the cost up to $500. Windows, doors, and skylights, 10% of the cost up to $500. I've seen clients with windows and doors and with insulation. Now, windows are capped at $200 for total lifetime. Again, people, I don't need to remember this. I plug in the amount. If they give me the receipt and say, I got new windows for $2,700, I'll plug it in and the software will do the calculations for me. These residential property improvements, air source heat pumps, that could be something. Central air conditioning. We've got a lot of people who are replacing their air conditioning. Non-solar water heaters. The tax credit amount is up to $300 if they're Energy Star certified. I don't know of anybody who's put in a biomass stove, but it's possible we could run into that. And then the last ones are solar electric property, solar water heaters, geothermal heat pumps, small wind turbines, fuel cell properties. This is based not on a dollar amount, but on a percentage. Whatever the cost was in 2021, they'll let you take a credit of up to 22%. That's a different amount. However, I don't think anybody except maybe solar electric or solar water heaters is probably, we might run into one of those. I doubt it.
I have not seen one. And you would think, okay, well, yeah, solar panels, right? I mean, we're seeing a lot of that pop up, but most of those, they get leased.
And that's the deal here. If you've leased a solar system, it does not qualify. You have to have purchased the solar system. And so if you get into the TaxSlayer screenshot, there is a form, 5695 for energy efficient improvements. And if you put the solar system purchase price, you just plug it in, the TaxSlayer software will count up and do all the calculations and do the figures for you. Then you have to hit the continue button to move on. All right, this is a biggie, I think, because so many of our clients have kids in college or going into college or are just going through college. So we have 2 credits. the American Opportunity, and the Lifetime Learning. You can take the credit for yourself as a taxpayer, your spouse, your dependents who have attended an eligible post-secondary educational institution during the tax year. Now, on these next few screens, I'm going to tell you the differences between the two. The American Opportunity Credit is available for the first 4 years of college per eligible student. You graduated from high school, you're going on to college, the American Opportunity Credit is the one to use. The Lifetime Learning Credit, it's just exactly what it says in the name. It's available every year of your life. You can take it and apply for a graduate, maybe you're taking a graduate course or professional degree course, but the key here is that second part after the dash, including courses to acquire or improve job skills. If you're working on acquiring or improving the job skills, that's a key for Lifetime Learning Credit. Now, the Lifetime Learning Credit, not as expensive of a credit or as great a credit. It's only 20% up to a max of $2,000. So you could have $10,000 in expenses and you're going to get a credit back for 20%. But the American Opportunity Credit, it covers the first $2,000 at 25%. And then, excuse me here, I keep running into windows that pop up and block part of my screen. Up to the amount of the tax or a maximum of $2,500. It gives you a little greater credit than what the Lifetime Learning Credit does. The Lifetime Learning Credit is non-refundable. It will lower your tax to zero, but not go any farther than that. The American Opportunity Credit is one of those hybrids. It's kind of refundable and it's kind of not. 40% of the credit is refundable. So you can get $1,000 back out of the maximum $2,500 as refundable. Education credits are found in tab J. And in tab J, there's a page, I think it's 8 and 9, maybe it's 2 and 3 this year. I'd have to go back and look. But when you open it up, you have to turn your book the other way, and it's a big long chart going down the page, and it lists the various education credit information and compares them. And it's a great resource for you to work on. But you don't have to know that much about what you're inputting. The software will take care of the calculations. You're going to have to ask who can be claimed as a dependent on someone else's return. If you're claimed on someone else's return, there's no way you're getting a credit. If you're married filing separately, there's no way you're getting a credit. If your AGI is above the limit for your taxpayer's filing status, you're not getting it. And they raised the adjusted gross income level for the Lifetime Learning, so it now matches the American Opportunity Credit. They're now both 80,000. So at 80,000, excuse me, 90,000, you're now above the limit. At 80,000, the credit begins to be what they call phased out. It's lowered a little bit for each $50 or $100 of income growth. But when you hit 90,000, you're out of the ballpark. It's zero credit for you. And if you were a non-resident alien for any part of the tax year and you didn't elect to be treated as a resident alien, then you're out of the credit. So these are things that will disqualify you for being considered. Education credit amounts are based on qualified education expenses. To claim that credit, the taxpayer has to claim the student as a dependent. Expenses have to be paid to an eligible education institution. Proof of expenses, such as documents as receipts or Form 1098-T, the tuition statement issued by the school, are required. Now, I put a little asterisk there because sometimes the institution is not required if, like, all of the expenses were covered by a scholarship. But generally, I would say almost all the time, the people come into us and they say, here's my 1098-T, and that's what we start working from. Now, the 1098-T, the tuition statement, is not going to cover every piece of qualified expense. So we'll get to that in just a couple slides, how to get some more information. Here is a sample 1098-T. Box 1, these are your qualified educational expenses. This is what most clients will bring to us. Any expense that's paid for the student, regardless of who, is considered as the student having paid the expense themselves. Now, they don't count student loans or gifts from family members. They're not treated the same as scholarships and grants. None of the credit is refundable if the taxpayer claiming the credit is under age 18 or age 18 at the end of the year and their earned income was less than half of their own support. So you've got a 19 or a 20-year-old going to college, but they're living at home and their parents are paying more than half of their support, then it's not going to be refundable to them. If they're a full-time student over 18 and under 24 and their earned income was less than half. If they do not file a joint return unless to claim withholding on wages. And to me, frankly, I don't really worry about that because the information I enter into the software when I talk about the dependency and the age of the dependents back at the very beginning of the software, when I get to the education credits, I just enter the tuition statements, the software does the calculations and applies the rules. Now, for the American Opportunity Credit, expenses for books, supplies, and equipment that the student needs for a course are included in the qualified education expenses, even if it is not paid to the school. Some schools have some weird accounting procedure set up. It could be the cost of a required course book is bought from an off-campus bookstore. Well, that's a qualified education expense. So your 1098-T, comes from the Fulton College. This is all the stuff that was bought at the college. It could be the tuition, it could be for something in the bookstore. But if the student went off-site and they went to Best Buy and they bought a computer and they went to Amazon.com and they had them ship 3 books to them, as long as they have the receipts for those, you can add those receipts in to the total for expenses here. In other words, these expenses on the 1098-T were generated by the college, but they're not all of the qualified expenses. Now, remember that for the American Opportunity Credit, the student has to be pursuing a degree, certificate, or other recognized education credential in the first 4 years of non-secondary college. But the lifetime learning credit can be taken anytime, especially if they're just acquiring or improving their job skills. And they do not have to attend at least half-time, and they do not have to be pursuing a degree. And the qualified expenses are just for tuition and registration, but not for books, supplies, and equipment. They could be qualified expenses if the fees have to be paid to the school for enrollment. I'm giving you lots of rules. The key here is on this one, if you've got a student coming in and they're in those first 4 years of college after they've graduated from high school, if they're not doing if they're not carrying at least half a load, they're probably not going to qualify for the they won't qualify for the American Opportunity Credit, but they will get the lifetime learning credit. And remember, I said that the American Opportunity Credit is good for 4 years. And you can only take it 4 times. After that, it's gone. So once again, here's that 1098-T. When we see that, these are the questions we want to ask our client. Is this your first time in college to get a 4-year degree? If it is yes, we're going for the American Opportunity Credit. Can you be claimed as a dependent by anyone? If it's yes, no, you don't get the credit. If it's no, woohoo, you get the credit. Now, if it's your parent who comes in, the parent of the student, and they say, is this your child's first time in college to get a 4-year degree? Yes. Okay, great. Can your child be claimed as by a dependent by anybody else? No, we're still looking good. Do you have a 1098-T from your college? Yes. Okay. Then you ask, what other expenses do we have to add to this? Because that is just the 1098T covers the expenses that the college had. And that's the fourth question. Do you have any other expenses that you paid for college? So those are the things we want to ask our clients. Now, all those expenses are reduced because you may not include any amount that you receive from tax-free scholarships or fellowships or federal Pell Grants or other non-taxable assistance other than gifts and inheritances. Qualified expenses. First bullet, that's pretty well we covered. Second one, the second one, you could pay in 2021, in December of 2021, you could pay for January, February, and March of 2022. You could pay your tuition and fees for college next semester in December, and they would be counted in your 2021 tax year. The following are not qualified education expenses. And I hate to say this because in a few screens, I'm going to tell you that there are some cases where some of these are. Room and board, insurance, medical expenses, transportation, student fees. This is the room and board, insurance, medical expenses, and transportation. Those are the biggies that are normally considered not qualified expenses. If it's part of a student's degree program, the student's degree is in physical fitness, health maintenance, something like that. Okay, then a course in fencing could be considered a qualified educational expense. For the lifetime learning credit, those expenses qualify if the course helps the student acquire or improve their job skills. That's that key again, acquire or improve job skills. In 4012, tab J, there's a summary of the differences. This is a screenshot of part of the pages. The simple situation dealing with scholarships looks like this. They've got $650 in qualified expenses, and they've got a $500 scholarship. You cannot enter in TaxSlayer the payment of $650 in box 1 in the software. You have to do the calculation yourself. We have to get out our calculators on our phones, take pencil and paper, and do the calculation and come up with $150 of qualified expenses. The software at this point does not do that calculation. I really don't like doing calculations. I really like the software to do it for me because I make mistakes. Qualified expenses must be reduced by the amount of any tax-free educational assistance. Now, here's just a general set of slides that talk about the importance of scholarships and how prevalent they are in our country. 58% of the families use scholarships to help pay for college. 1.7 million private scholarships. The Pell Grant provides aid to 7.5 million students. 16% of students receiving a state scholarship. 7% of students are likely to receive a scholarship. $8.8 billion was awarded in need-based scholarships. This is an area that affects an awful lot of the percentage of our population. And so we're going to have to deal with these. Now, most commonly, a grant restricts how the money is going to be spent. And the grant sponsor could require proof that the money was spent on authorized expenses. And the grant must be repaid if the recipient fails to meet a set of stated goals within a certain period, or maybe it's repaid if the student drops out of college later. The grant requires the recipient to do something extra in return for the grant, like, for example, work for a specified number of years in a given occupation before being able to continue their career freely. This is a restricted grant. Well, there we go. I'm going to let you read that. An unrestricted grant. By default, a grant is unrestricted. They're not going to put any restrictions on it. So we kind of have to ask our clients, and sometimes they won't know, was your grant restricted or unrestricted? And in a few slides, I'll tell you an easy way that we can deal with most of those. Oops, let me back up. Oh, that zipped right through it. This is the legal definition of a qualified tuition and related expenses. You can read it later on at your leisure when you're tired and sleepy. Okay, here's a good example of restricted and unrestricted grants for allowable expenses. The Coverdell ESA, the Coverdell Education Savings Account, it only covers tuition fees, books, supplies, and equipment. That's a restricted grant. The Pell Grant, on the other hand, is unrestricted. You can use a Pell Grant to pay for your room and board. Maybe you want to rent a house, a block off college campus, and you pay the rent, to buy food, to pay for your gas to drive to college, or even buying and repairing your car. Or if you have a child, take care of the daycare cost, all for you to help you get to college and attend college. So those are examples of unrestricted and restricted. And remember, on that screen earlier, a Pell Grant is used by what I think I said, 7.5 million people. Now this situation becomes a little more complex. We still have our qualified educational expenses in box 1, but in box 5, the scholarship now exceeds the qualified expenses. Now, we take our scholarship. The software doesn't do this. We have to do it. We have to subtract the qualified expenses, and we come up with unearned income. Under the underlined part, in 2020, the first $1,100 in a child's unearned income is tax-free. The second $1,100 is taxed at the child's tax rate, and any unearned income over $2,200 is taxed at the parent's tax rate, and that is called the Kiddie Tax. The Kiddie Tax is out of scope for us, but it only occurs in one situation. Both of these conditions have to be met. If the unearned income exceeds $2,200 and the dependent student has a filing requirement. So if a student comes to me and says, here's my 1098-T, and they got a $5,000 scholarship, and they only used $2,000 for qualified expenses. So they have $3,000 of unearned income. So it exceeds that $2,200. Then I have to look at, do they have a filing requirement? So I look at, okay, what was your total income of earned income? Do you have a W-2? Do you have a job? Do you have more than $12,550 that would require you to file? And if they've got $10,000, they don't have a filing requirement. They can still file. They can still get their withholding back, but they don't have a filing requirement. And since that condition isn't present, the Kiddie Tax is not enforced. I have had a client in the past who she had a scholarship for like $18,000. And she only spent about $3,000 at college that year, but she also bought a car and put the down payment of like $8,000 or $9,000 out of her scholarship on the car. That was the first mistake. Then the second mistake was her earned income was also greater than, at that time, it was $12,200, I think, for the filing requirement. So she was kiddie tax, but she had been there that morning from the time she signed in all the way through until she got to me at quality review. And I told her, I'm sorry, you're out of scope. You've been here for 3 hours and we can't do your return. This needs to be checked up front. Doesn't happen very often because most of the time when the kid's in college, they won't fulfill that dependent student has a filing requirement, but sometimes it does. Now, if your child's a full-time college student, you can claim them as a dependent until they're 24, even if they're away at school, because that's a temporary absence. If they're working while in school, you still have to provide more than half of their financial support to claim them. Remember, dependency is based on who is providing more than half of the support and that they lived with you at least 6 months of the year. But if they're away at school, that's called a temporary absence. So the 6-month rule still applies. You still may be able to claim them as a dependent, even if they filed their own return. And that's what we're going to cover. If they're single, they're usually required to file a federal return if they have earned income of more than $12,550. That's the standard deduction. If they have unearned income from interest, dividends, or capital gains of more than $1,100. If married, these are the criteria for being married. I don't worry about that. I plug in the 1098-T, I plug in the dependency. The software does all this calculation. Now, if your college student is your dependent, because you as the parent have provided more than half of their support, you may be eligible for the education tax credits. But there's also an income threshold for these benefits. So if your income is going to exceed $80,000 or $90,000, $80,000 is when it starts to phase out, $90,000 is when it cuts out. So if you exceed that income threshold, then the credits are no longer available to you. Most of the clients we deal with, all of the clients we deal with, fit this category. They don't have to worry about those income thresholds. If your college student is not your dependent because they provided more than half of their own support, then they may be eligible for the education tax credits. Most often, the thing I wind up with is talking with a college student who says, this is my first time filing my taxes. My parents are not going to claim me. I'm going to claim me. And then I have to stop and say, that's not a choice that you or your parents get to make. Here are the questions. Where do you live? At home. Who pays the rent or the mortgage and the property taxes and the utilities and the insurance? My parents do. Then they're paying more than half of your support. So you are their dependent, period. This is the tax layer screen. It's in two parts. We start on the left at the top, we go all the way down to the bottom. Then in the right column, we continue going all the way down to the bottom. Notice that you have yes or no questions when you get to the bottom. And notice, well, let's start over on the left-hand side. So you select which type of credit. Now, this tuition and fees deduction's gone away. That's not going to be there anymore. It's just going to be these two. The qualified expenses. This is what you're going to put in. There's no spot for you to put in scholarship received. We have to do the calculation ourselves. Then we put in the institution information. Whoops, let me back up. Then we come up and start answering questions. Did they receive the 1098-T? Yes. Did they have the student receive the 1098-T and had box 7 checked? No. What's the EIN number for the institution? Have they already received Hope Scholarship Credit or American Opportunity Credit? It was originally called the Hope Scholarship Credit. Now it's called the American Opportunity Credit. and it's good for only 4 times. Was the student enrolled at least half-time? You got to be half-time in order to get the American Opportunity Credit. Did they complete the first 4 years prior to 2021? No. Was the student convicted before the end of 2018 of a felony? Woohoo! What about this? Well, when they reauthorized the American Opportunity Credit, a legislator said, or congressperson said, we don't want to give federal credits to anybody who's been convicted of a felony. And so they put this in. And so if the person answers yes to this, they're not eligible for the American Opportunity Credit. And then you click continue. Bruce and Tony are married, filing a joint return. Their AGI is $65,500. Tony's attending the local community college part-time to earn the credits toward an associate degree in nursing. She already has a bachelor's degree in history. She wants to become a full-time nurse. She paid $2,500 in tuition. Their son, Ben, is a full-time freshman at the State University. Bruce and Tony paid $8,000 in tuition and fees for Ben. So which credit is Tony eligible for on her tuition and fees of $2,500? Lifetime learning credit. She's taking part-time courses to improve her job skills. She's working towards a nursing degree. She already has a degree. Oh, this is kind of interesting. Mary and John filed a joint tax return. Andy was enrolled full-time in college in 2018. He dropped out of college in 2019. In 2017, they took out a personal loan to pay for his tuition and fees in 2018, and they repaid the loan in 2019. Which year can they be entitled to claim the education credit? Boy, they've got all the years covered here. Are eligible to claim the credit for the year in which the taxpayers paid the expenses. Paid the expenses. We're not worried about when the loan was taken out. We're not worried about when the loan was repaid. When it was paid the expenses. Ooh, now this one's tough. Because this is one of those things, I'm asking you to do a calculation. Oh man, I don't do calculations. Let the software do it. Mark paid $3,900 for his son's tuition last year. What's the maximum potential amount for his American Opportunity Credit? I'm not going to ask you to think about that. Let's just tell you it's going to be $2,475. You get 100% of the first $2,000 and 25% of the second $2,000, which is in this case $1,900, and that's how it's calculated. Okay, they do have some of the same requirements. So which of the following is true for both education credits? A, there's no limit to the number of years the credits can be claimed. That's false. American Opportunity can only be claimed 4 years. Expenses related to non-credit courses are allowed as qualified education expenses. Non-credit courses? No. The credit is available for only the first 4 years of post-secondary education. Lifetime learning is available anytime in your life. To be eligible for either of the education credits, you must use any filing status other than married filing separately, which is to say married filing separately is not going to get you a credit. And that's correct. Now,
Hey, can I jump in? And I promised these guys I would tell them about the poor man's loophole.
okay.
And it's what time is it now here? Well, it's 1:45. And well, go ahead and let me take over the screen here, because just so that I can show.
Okay, hang on a second here.
I got it. I can, if I do it, it's going to bump you out. You know, Gene talked to you about restricted grants and unrestricted grants. And by the way, that one slide that was talking about the Pell Grants, or the qualified tuition and related expenses, that was telling you right from the IRS that a Pell Grant is unrestricted, meaning it can be used for anything. A restricted grant might be one that comes from, I don't know, the JCs, and they say, hey, this can only be used to pay your tuition, period. That's a restriction. So I want you to make sure you understand that distinction first. There's another thing I want to say about these 1098-Ts. I've almost yet to see one that is accurate. And I don't know why that is, but for some reason, the way the colleges are calculating stuff, they're using carry forwards from the prior year or whatever. I don't know, but I almost always tell the student, you need to go on to your student account and download your record of account that shows everything that was charged and everything that was paid and where it was paid from. Because I almost always find expenses that don't get captured up here. And how do I know what exactly those expenses are? Gene alluded to it. There's under tab J of the 4012, there's that fold out that you've got to turn sideways. It's on J3 and J4 that really give a comparison of all of the credits and all of what's qualified expenses and stuff for that. I would get really familiar with that. Now I'm going to give you the example of where it might be beneficial to actually pay taxes on a student scholarship that he wouldn't have to. So let me refresh your mind. Like, we're looking at this 1098-T here, and we're saying here he got 1,000 of scholarships, but we don't have to pay taxes on this 650 because it was used for eligible expenses, right? For 1 minute, I want you to just kind of replace these numbers. I can't edit this slide right here, but let's just assume he got $4,000 of scholarships and grants. And let's assume that they are unrestricted. Okay, there's no restriction on it. You don't have to use them to pay for, let's call it a Pell Grant. Okay, it's $4,000 Pell Grant. Now, up in here, two things. This might have said $3,500, and then when we quizzed the student, they said, oh yeah, but hey man, I paid $700 in books, right, that I didn't pay to the school. So they've got $4,200 of qualified expenses. Or let me make the math simple. They've got $4,000 of qualified expenses. So they have a scholarship of $4,000. They have $4,000 of qualified expenses. Hey, great. You don't have to pay tax on any of that. However, how can I claim an American Opportunity Credit? Because his expenses got all eaten up by the scholarships and grants. So he doesn't get a credit. Here's what we can do is we can say, hey, look, we'll let you pay taxes on this $4,000. Now, if he's independent and this is his only income, he's not going to owe any taxes because he's got a $12,550 deduction. Now, it really gets more complicated because as usually he's being claimed on his parents' return, and now he's going to probably be subject to the kiddie tax because we're going to claim him as having $4,000 of income, all unearned. And remember, I'm going to refresh your memory. First $1,100 is taxed at his rate. Second $1,100 is taxed. Oh, I forget what it is. Then the rest is taxed at the parent's rate. So let me just give you an idea. He's going to claim this $4,000, and he's probably going to have to pay $800 in taxes on it. But look at this. Now we get to use that $4,000 to claim the American Opportunity Credit. And how much credit is that going to generate? It's going to generate $2,500 in credit, even though we got to pay $800 tax on the $4,000, right? So bottom line, I just wanted you to be able to be aware of that, okay? When you run into something like this, get your site coordinator involved because there may be some tricks that we can do to maximize their credits. Okay, this is perfectly allowable. It's in publication 950. Well, as I said, this is the one loophole that us poor people get to take sometimes. So I wanted to do that. We've only got about 10 minutes left. What I would like to do is use the last 10 minutes to cover any questions, and let me kind of look up in to here. So Connie says, if I have additional expenses than what is listed on the 1098T, do you just add those to the amount on the 1098T? And do you need documentation? And the answer to that is generally yes. Okay, you add them to in addition to what is, but as I said a moment ago, I would get them to print out their record of account, and I'd go down and add in what the charges were and how those charges were paid for, right? Just to make sure that there weren't any restricted scholarships. And that's kind of hard to tell sometimes, but usually you can ferret that out. You know, most often it's Pell Grants and it's student loans. And that means there's no restrictions in it, okay? But yes, you need to add those. And then they bought books on Amazon. I've been a college teacher for 20 years. And, you know, they go into our bookstore, and let me tell you, these books can be expensive. It's $125 in our bookstore, but they go onto Amazon and they get it for $80, right? So they'll buy it at Amazon. And so it won't even show up on their record of account. But you're asking, do they need documentation? I don't have to see documentation, but if they get audited, you know, they've got to show documentation. So I tell them, I said, are you sure you spent $80? Oh yeah, I got that's on my Amazon account. I'm going to tell them, go print that receipt out and put it here with these records, so you got it in case you get audited. Okay, and then we add that up and we count it. Then, are there any other questions right now? We've got a few minutes here.
Jim, if you are putting in the 1098T and it has 650 in that first thing, but then they show you $1,000 of qualified expenses, do you put that in on a different line, or do you put it in on the box there where you're putting in the 1098?
Well, actually, there's no form for the 1098T, I don't think.
Okay.
And when you get to the American Opportunity Credit, it's just going to ask you to enter in the total of qualified educational expenses. And you're going to take the amount from the 1098T. And actually, what I'm telling you is I would try to get the student statement. Okay. But maybe they can't get that. We can rely on the 1098T. I mean, that's reported to the IRS. And then whatever additional expenses they tell us, we add those together and we put it in that one box that says total qualified educational expenses.
So we're the calculator for this one thing. All right.
Yes, you're going to need a calculator. In fact, I'll tell you what I do. I have them, and I work at a college. I run into this a lot. I have them log into their account, either at ASU or the Maricopa Community Colleges. I have them print out their statement for the year. And then I take and I go down and I circle the ones that are required to be paid by the institution. For instance, ASU, they got about 4 or 5 different fees that you've got to pay. The student is required to pay for a scholarship fund. They're required to pay for the gym, whether they use it or not. They're required to pay, I don't know, I forget what else. But see, sometimes that 1098T doesn't capture all those, and I don't know why they don't. But I sit there and I circle the ones, and then I get an adding machine or a calculator or a spreadsheet, whatever, and I add them up, and I total them right there on that sheet, and I tell them, keep this with your tax things. And then, so Mary Ellen's saying, and then where would the unearned income do if the scholarship exceeds qualified expenses? So
Yes, where would it be reported in TaxSlayer?
Okay, we showed you a couple of those screens. Let me see if I can walk you back through it.
Oh, okay.
You go to the income screen.
Okay.
At the bottom of the income screen, it says other income.
or does it say less common income?
Yeah.
Maybe it's
Right. Okay.
less common income. And then the next screen, it's like the third one down. It's like other compensation on that menu. And then when you click begin on it, then it takes you, and there'll be on that sub menu for that one, there'll be one that says scholarship income. And it's just one block, and you plug it in there.
Yeah, it's been a long day. I forgot. I think that was that yesterday or was that today? Okay.
I have to applaud all of you. I know sitting through, 7 hours of this stuff is, I mean, it's like a fire hose, spraying it down. And I want to reaffirm, don't freak out that you're not getting all of this all at once. We really want to teach you where to go look for the information. And, you know, a few minutes ago, I don't know if all of you were listening in on that. I think it was Beth or Jennifer. Somebody asked me about, well, isn't there a phase out of the child tax credit if their income's too high? And yeah, in my head, I knew that was. I thought that the last Tax Act really increased that phase out. And I said, well, let's go look. And I pulled up the 4012, and no, I was wrong. It starts phasing out, I think, at what, $150,000 of income. You're not going to see that with our clients, right? They don't make that much money. But the answer is yes, there is a phase out. You cannot memorize this stuff. You got to learn to go look it up and where to put your hands on it quick.
And you also need to make sure that you know where to put it in the software. The software will do the calculations. The thing that will take you the most time in doing a tax return, the first 5 or 6 returns you do, will be scrolling through the software going, okay, now where the heck was that menu?
Okay, so we're at 4 o'clock. I'm going to stop the recording.